So in a pump and dump scheme, a promoter or sometimes somebody who owns stock hires a promoter, and then the promoter would essentially pump the stock by providing very positive, often false and misleading news about the stock to pump up the price, with the goal to then the stock that was previously purchased at a cheaper price to then sell it at a high price. And when they sell the stock, then the stock would basically crash, and that's the dump phase of the pump and dump. Looking at the literature, we have quite a bit of evidence and research on both sort of capital formation and how securities regulation affects market quality, things like market liquidity. But we actually have a lot less work on investor protection. And so we don't even have evidence on some of the most basic questions in investor protection and market manipulation. So for instance, the question, what is the participation rate of investors in these schemes? How much money do people invest? How much money do people lose? Those were questions that we don't have or didn't have the answers to. In part, we can see the stock price going up and then going down. So we know sort of what the path looks like, but we don't know when did investors buy the stock, when did they sell, how much did they lose, which are the investors that participated in these stocks and why. And so if you want to have an effective investor protection regime, it seems important to understand, who participates, why they participate, how much money they lose, and so on. So those were the questions that we were after. A second set of questions that I think are also quite interesting and important from a regulatory perspective is what happens after somebody participated in a scheme, and to what extent do these schemes potentially have ripple effects. So the idea here being, if you have been investing in such a scheme and have been defrauded, to what extent does it affect the future investment behavior of these people? Because if there are these ripple effects, so if somebody, after they've been duped into such an investment and lost money, if they stop participating in the stock market, then these schemes and pump and dump schemes have much broader ramifications and much bigger costs, because they may taint the reputation of stock markets, reduce stock market participation by investors, and those ripple effects, which economists call externalities, would be sort of a reason for us to go after these fraudsters and to be much more concerned about them. So for this project, we essentially combined two different data sets. The first data set was a large data set of individual investor trading data and securities data. So we basically had access to confidential data for over 110,000 investors over a long period of time, for which we see every single trade, and we see all the securities that they have in their portfolio. And then we have a second data set, which was given to us by the German securities regulator or supervisor BaFin, which includes all the pump and dump schemes that they have investigated and then passed on to the prosecution. And then what we do is we cross these two data sets. Because we know when the schemes are taking place and we have all the trades that these investors were doing, we can essentially look who bought when these stocks were being pumped. We can also look whether somebody has bought the stock ever before. We can look at how much they invest, when they sell, and how much money they lose, and so on. And then we can start answering the questions that I was describing earlier. Participation in market manipulation or in these pump and dump schemes is actually quite common among investors. So we find that about 6% of the investors in our sample are at least once participating in a pump and dump during our sample period. People lose on average about 30%. A quarter of the investors lose over 60% of their investment. We also see that investors place large bets or make large trades. And as a result of that, the economic losses are quite significant. Our estimate is that the losses from a single scheme are conservatively estimated at least $1.4 million. That would put you in the 90th percentile of criminally prosecuted fraud in the United States. So in that sense, they're not small losses. So we do find that some of the demographics are significant. So blue-collar workers, retirees, self-employed are more likely to participate. But overall, the demographics, other things like gender, age, don't actually explain a great fraction of the variation in participation. What is much more important in terms of explaining participation is actually past trading behavior or the portfolio composition. So if we see the portfolio and we see what people have done in the past, that helps us predict much more who would be participating in a future pump and dump. And so in essence, I think the message here is that revealed preferences through past trading behavior are much more powerful than demographics. The most surprising finding for us was that there are a significant number of investors that participate several times in these frauds and lose money often every single time. So there's people who invest 3, 4, 5, 6 times in these pump and dump schemes. And so then what we started doing after we saw this, we basically tried to characterize investors by different investor types. And we find that there's about 35% of the investors who day trade in penny stocks or trade with very short investment horizons. And for those investors, we believe that it's unlikely that they're being duped or fooled by these schemes. They're more likely to participate willingly or might even seek these schemes. So we also see some evidence that having invested and lost money would change subsequent investment behavior. In particular, people that lose a lot the first time they do this, they would tend to subsequently invest more conservatively. And then conversely, actually people that participate in actually maybe the first time around make some money or don't lose so much, they actually get encouraged and seem to be investing larger amounts and faster than other investors. So the current regulatory approach focuses a lot on investor education and essentially making people aware of the risks that they're taking with these kind of investments. Now, the most important finding from a regulatory perspective in our study is that there's a significant fraction of investors who are probably not being duped or fooled by the schemes and who participate willingly. And as a result of that, I think the regulatory approach that we need needs to be more nuanced, needs to be a two-pronged approach that recognizes that there's different investor types and different trading motives. So to describe this a little bit more, so think about warning signs or investor education efforts that basically tell people not to invest in these stocks. Those are probably not going to work for people that participate willingly. In fact, it might even have the opposite effect, because what could be happening is that the warning sign becomes essentially a signal to those investors that there's a bandwagon to jump on. So what's a red flag to some is a green flag to others, which is why transparency isn't enough. What's important is that I'm not saying that we don't need transparency or we don't need investor education or these warning signs. Those approaches are important for the people that are being fooled by these schemes, which is probably still the majority. And if we reduce the participation of those people, we reduce the profitability of the schemes, which in turn then makes it less profitable to create the schemes in the first place. So that's a useful strategy, and that's sort of one prong. The second prong needs to basically tackle those people who probably participate more willingly with a gambling motive, or because they have some lottery preferences, or because they're sort of playing in these markets. And for those people, I think we have to tackle the problem from the supply side, reducing the supply of pump and dump schemes. And so here, what we need to do is basically increase the costs to the fraudsters, make it more likely that they're getting caught. So enforcement efforts, for instance, using data analytics to very quickly identify these schemes, suspending the trading so that they become less profitable. It would entail going after the broker dealers that are perhaps facilitating trades in these fraudulent schemes. It would probably entail also reducing the supply of penny stocks that are being used in these promotions. And so here what one could do is suspend or even expel stocks that are dormant or shell companies that are often used in these promotions.